Something shifted in the silver market over the past several weeks that hasn't happened in years. Not a crash, not a rally, something more subtle, more structural, and far more important for anyone who holds physical silver, mining shares, or has been watching precious metals as part of their long-term strategy. If you're watching this video, you likely fall into one of two categories. You either already own silver and you're trying to understand what's happening beneath the surface of recent price action, or you've been considering adding silver to your portfolio and you're wondering if this is a moment of opportunity or a trap. This video is for both of you. But I want to be clear from the start about what this is not. This is not a hype video. This is not a prediction that silver is going to 10 times its current value by next Tuesday. And this is not financial advice telling you to buy, sell, or panic. What this is a breakdown of what has changed, why it matters, and how thoughtful investors should be thinking about this moment. Because whether you realize it or not, we are living through one of the most significant monetary transitions in modern history. And silver, often overshadowed by gold, is sending signals that most people are either ignoring or misinterpreting entirely. Let's walk through this carefully. Let's look at the data, the history, the psychology, and the macro forces that are converging right now. And by the end of this conversation, you'll understand not just what's happening, but how to think about it without getting swept up in emotion or confusion. The first thing we need to establish is what abnormal actually means in the context of silver. Because silver has always been volatile. It's a smaller market than gold. It's both a monetary metal and an industrial commodity. It moves fast, it overreacts, and it punishes impatience. So when I say something abnormal has occurred, I'm not talking about a 10% swing in a week. That's normal for silver. What I'm talking about is a disconnect between supply fundamentals, demand signals, and price behavior that suggests the market structure itself is under stress. Over the past month, we've seen something unusual. Physical silver premiums, the amount dealers charge above spot price, have widened significantly in certain markets. At the same time, available inventory at major bullion dealers has tightened. Delivery times have extended, and yet the paper price of silver, the price you see quoted on financial websites, has not reflected this physical tightness in a proportional way. This divergence between the physical market and the paper market is not new. It has happened before. But the degree and the persistence of it right now is noteworthy. It suggests that the traditional price discovery mechanism, the way silver's price is determined through futures contracts and derivative trading, may be losing its grip on the underlying physical reality. Now, why does this matter? Because if you're someone who owns physical silver, this is not a red flag. It's a green one. It means the asset you hold has tangible, real-world demand that is not being fully represented in the price. It means scarcity is building quietly while the majority of market participants are still trading in a world of digital contracts and leverage. But if you're someone who doesn't own silver yet, this moment requires careful thought. Because while physical tightness can eventually drive price higher, it doesn't happen overnight. And in the meantime, volatility can shake out those who don't understand what they're holding or why. To understand why silver is behaving this way, we have to zoom out and look at the broader financial system. Because silver doesn't move in isolation. It moves in response to forces far larger than itself. Let's start with debt. Global debt, both public and private, is at levels that have never existed in human history. Governments around the world are running deficits that cannot be sustained without continued central bank intervention. That intervention takes the form of money creation. And when money is created at a pace faster than real economic growth, the purchasing power of that money declines. This is not a political statement. This is not a doomsday prediction. This is observable fact. The money supply has expanded dramatically over the past 15 years, especially since the financial crisis of 2008, and again during the pandemic response of 2020 and 2021. When currency loses purchasing power, people look for stores of value. Historically, that has meant gold and silver. But silver has an additional characteristic that makes it particularly interesting right now. It is also an industrial metal. It is used in solar panels, electronics, electric vehicles, and medical applications. Demand for silver from industrial sources has been growing, not shrinking. So you have a situation where monetary demand is rising due to currency concerns, and industrial demand is rising due to technological transition. Yet the supply of silver has been relatively stagnant. Mining production has not kept pace, recycling cannot fill the gap, and above-ground inventories are being drawn down. This is what investors call a supply-demand imbalance, and when that imbalance persists, price eventually adjusts. The question is not if, but when and how violently. Now, let's talk about interest rates. For years, the narrative was that rising interest rates are bad for precious metals because they increase the opportunity cost of holding non-yielding assets, and on paper that makes sense. But in reality, the relationship is more nuanced. What matters more than the nominal interest rate is the real interest rate, the rate after you subtract inflation. If inflation is running at 5% and interest rates are at 4%, the real rate is negative 1%. In that environment, holding cash or bonds means you are losing purchasing power. That makes hard assets like silver more attractive, not less. Right now, despite central banks raising rates over the past 2 years, real rates in many parts of the world remain low or negative when you account for actual inflation, not official inflation statistics. Food, energy, housing, insurance, these costs have risen far more than government data suggests. And people feel it. That feeling drives behavior. This is why silver, and gold for that matter, have not collapsed despite higher nominal rates. The underlying monetary reality is still one of currency debasement, fiscal imbalance, and declining confidence in the purchasing power of fiat money. Here's where most people go wrong. They treat silver like a stock. They look at the chart, they see volatility, and they assume it's just another speculative trade. Buy low, sell high, repeat. But silver is not a stock. A stock represents a claim on future earnings of a company. Silver is money. It's been money for thousands of years. It doesn't have earnings. It doesn't have a business model. It doesn't issue quarterly reports. Silver's value is derived from its scarcity, its utility, and its role as a hedge against monetary instability. When you own silver, you own something that cannot be printed, cannot be defaulted on, and cannot be inflated away. That's the point. But because silver is priced in dollars, and because most people think in dollars, they confuse price volatility with loss of value. If silver drops from $30 an ounce to $25, they think they've lost money. But what if during that same period, the dollar itself lost 10% of its purchasing power? Then silver didn't lose value. The measuring stick changed. This is the psychological trap that most investors fall into. They anchor their thinking to the currency, not to the asset. And as a result, they make emotional decisions. They sell when they should hold. They avoid buying when they should accumulate. They react to noise instead of thinking in cycles. Another common mistake is conflating paper silver with physical silver. When someone says they own silver, the first question should be, do you own physical metal, or do you own a financial product that claims to represent silver? There's a massive difference. Physical silver is yours. It's in your possession or in allocated storage. Paper silver, whether it's an ETF, a futures contract, or a mining stock, is a derivative. It has counterparty risk. It can be diluted. It can be manipulated. And in a crisis, it may not perform the way you expect. I'm not saying paper products have no place in a portfolio, but if your goal is to hedge against systemic risk, and if you're trying to own something that holds value when confidence in the financial system declines, physical metal is what matters. Everything else is a proxy, and proxies fail when you need them most. Let's look at history, because silver has been here before. Well, not in exactly the same circumstances, but in similar conditions of monetary uncertainty and market stress. In the 1970s, inflation was raging. Trust in the dollar was eroding. And precious metals went through a multi-year bull market that ended with silver reaching $50 an ounce in 1980. That wasn't a straight line. It was volatile. It had corrections. But the overall trend was driven by fundamental forces, not speculation. Then came the 1980s and 1990s. Interest rates were raised dramatically to crush inflation. Confidence in the dollar was restored, at least temporarily. And silver entered a 20-year bear market. It fell from $50 to below $5. Anyone who bought at the top and didn't understand the cycle got destroyed. Then, in the early 2000s, things began to shift again. Central banks started cutting rates. Money printing accelerated after the dot-com crash, and again after the housing crisis. And silver began a new bull market, rising from around $5 in 2003 to nearly $50 again in 2011. But once again, the cycle turned. From 2011 to 2020, silver was in a consolidation phase. It traded mostly sideways, occasionally dipping below $14. Many investors gave up. They assumed the bull market was over. They sold at a loss and moved on. And then 2020 happened. Pandemic response, unprecedented fiscal and monetary stimulus, and silver woke up. It doubled in a matter of months, from $15 to nearly $30. And since then, it's been consolidating again, building energy, while the macro backdrop continues to deteriorate. Here's the lesson from history. Silver moves in long cycles. It doesn't go up every year. It doesn't reward impatience. But when the cycle turns, it moves violently and quickly, and it rewards those who understood the fundamentals and stayed positioned. We are likely in the early stages of a new cycle right now, not because of hype, not because someone on the internet said so, but because the same monetary forces that drove previous bull markets are present again, only more extreme. Debt is higher, deficits are larger, trust in institutions is lower, and industrial demand for silver is stronger than it's ever been. Those are not opinions. Those are observable realities. If you already own physical silver, here's what you need to understand. You are not late, you're not holding the bag, and you're not foolish for owning an asset that has been consolidating for years. What you are is positioned, You own something real in a world that is increasingly digital, leveraged, and fragile. You own an asset that has withstood every financial crisis, every currency collapse, every regime change in human history. But ownership alone is not enough. You need to have the right mindset, because volatility is coming. If silver is going to move higher over the next several years, it will not do so in a calm, orderly fashion. It will whipsaw. It will shake out weak hands. It will test your conviction. This is why you need to know why you own it. If you bought silver because someone told you it would double in 6 months, you're not going to make it through the next downturn. But if you bought silver because you understand monetary history, because you recognize the risks in the financial system, and because you're thinking in decades, not days, then you'll be fine. Your job now is to stay informed, stay calm, and ignore the noise. Do not check the price every day. Do not panic when it drops. Do not get euphoric when it spikes. Think like a long-term investor, because that's what you are. And if you have the financial capacity, consider accumulating more on weakness. Not all at once, not with money you need for living expenses, but methodically, patiently, when the price dips and others are selling. This is how wealth is built in hard assets, not by timing the perfect entry, not by chasing rallies, but by understanding value, recognizing cycles, and having the discipline to act when others are paralyzed by fear. If you don't own silver yet, and you're watching this trying to figure out if now is the right time, let me be direct. There is no perfect time. There never is. If you wait for certainty, you'll wait forever. But that doesn't mean you should rush in blindly. It means you should educate yourself first. Understand what you're buying and why. Understand the difference between physical and paper. Understand that silver is volatile and that you may be underwater for months or even years before the cycle turns in your favor. If that sounds uncomfortable, good. It should. Because silver is not for everyone. It's not for people who need liquidity next week. It's not for people who panic at the first sign of a downturn. And it's definitely not for people who are buying because they saw a viral post on social media. Silver is for people who understand the long game. It's for people who recognize that the global financial system is built on unsustainable debt and currency debasement. It's for people who want a hedge, not a lottery ticket. If that describes you, then the question is not should you buy, but how much and in what form. And the answer depends on your personal situation, your income, your expenses, your risk tolerance, your time horizon. A reasonable approach for most people is to allocate a small percentage of their overall portfolio to physical silver. Not 50%, not everything, but enough that if the cycle turns in your favor, it makes a meaningful difference, and enough that if it doesn't, you're not financially devastated. Start with what you can afford. Buy from reputable dealers, take physical possession or use allocated storage, and then forget about it. Let it sit. Let the cycle play out, and revisit it in 5 years, not 5 weeks. This is not exciting advice. It's not going to get 1 million views, but it's the advice that actually works for people who want to preserve wealth, not gamble it away. Now let's talk about what you should absolutely not do, because this is where most people destroy themselves. First, do not use leverage. Do not buy silver on margin. Do not take out a loan to buy silver. Do not put your emergency fund into silver. This is a hard asset, not a growth stock. It doesn't have the same upside as a speculative tech company, and it doesn't belong in the same risk category. Leverage amplifies losses, and in a volatile market like silver, leverage can wipe you out before the cycle even turns. If you can't afford to buy physical silver with cash, you can't afford to buy it at all. Wait, save, and buy when you're financially stable. Second, do not chase hype. There are countless influencers, YouTubers, and anonymous accounts online screaming that silver is about to explode. Maybe it is, maybe it isn't, but your decision to buy or hold should not be based on someone else's prediction. Do your own research, understand the fundamentals, and make decisions based on logic and evidence, not emotion and excitement. Because when the hype fades, and it always does, you need to have conviction in what you own. Otherwise, you'll sell at the worst possible time. Third, do not try to time the market. Yes, silver will have better and worse entry points. But unless you're a professional trader with years of experience, you're not going to nail the bottom, and trying to do so will drive you insane. It's far better to dollar cost average, buying a little bit over time, than to sit on the sidelines waiting for the perfect moment that may never come. The goal is not perfection. The goal is participation. Fourth, do not ignore the rest of your financial life. Silver is one piece of a diversified strategy. It is not a replacement for income. It is not a substitute for an emergency fund. And it is not a reason to neglect retirement accounts, real estate, or business investments. If your entire financial plan is betting on silver, you don't have a plan. You have a gamble. And gambling rarely ends well. Finally, do not panic. When silver drops, and it will, you will see headlines screaming that the bull market is over, that precious metals are dead, that you've been scammed. Ignore it. This is the noise. This is the test. Markets do not move in straight lines. Corrections are normal. Volatility is the price you pay for owning an asset that is not controlled by central banks. And if you can't handle that, then silver is not for you. Let's step back and look at what's really happening here, because the abnormal market move in silver is not an isolated event. It's a symptom of a much larger problem. The global financial system is facing a credibility crisis. For decades, central banks and governments have operated under the assumption that they can manage economies through monetary and fiscal policy. Print money when times are bad. Raise rates when things overheat. Repeat. But we've reached a point where that playbook no longer works. Debt levels are so high that raising rates too much would trigger defaults and collapse. But keeping rates low means inflation continues to erode purchasing power. It's a trap with no clean exit. And people are starting to notice. Not just investors, but ordinary people. They see grocery prices rising. They see housing becoming unaffordable. They see their savings losing value even as the stock market hits record highs. And they're asking questions. This is the environment in which silver thrives. Not because it's a get-rich-quick scheme, but because it's a store of value that exists outside the system. It doesn't depend on government promises. It doesn't require trust in institutions. It just is. As confidence in fiat currency declines, as trust in central banking erodes, as people look for alternatives to a system that feels increasingly rigged, assets like silver become more important. Not overnight, not in a straight line, but steadily, inevitably, over time. This is not about predicting the collapse of the dollar next month. It's about recognizing that the purchasing power of all fiat currencies declines over time and preparing for that reality. Silver is not going to save you from every problem. It's not going to make you rich while you sleep. But it is going to preserve purchasing power in a way that paper assets cannot. And in an era of currency debasement, that matters. One of the hardest things about owning silver, or any hard asset, is the psychological burden of patience. We live in a world of instant gratification. We check stock prices in real time, we expect results immediately, and when they don't come, we assume we made a mistake, but wealth preservation doesn't work that way. It's not fast, it's not exciting, it's slow, boring, and often frustrating. You watch your silver sit there, doing nothing, while tech stocks double and crypto millionaires pop up on social media, and you wonder if you're the fool. But then the cycle turns. The bubble bursts, the euphoria fades, and suddenly, the boring asset you've been holding quietly, patiently becomes the thing everyone wishes they owned. This pattern has repeated throughout history, and it will repeat again. But only those who have the discipline to stay the course will benefit. The investors who win in hard assets are not the smartest. They're not the ones with the best timing. They're the ones who understand that investing is not about entertainment. It's about results, and results take time. If you can embrace that mindset, if you can detach your emotions from short-term price movements, if you can think in years instead of weeks, then you have a massive advantage over the majority of market participants who are trapped in the cycle of fear and greed. This is not easy. It requires self-awareness. It requires discipline. And it requires a willingness to be misunderstood, sometimes for years, while others chase the latest trend. But it works. And when the dust settles, when the current cycle plays out and the next one begins, you'll be glad you stayed the course. So where does that leave us? Silver has made an abnormal move. The physical market is tightening, macro forces are building, and investor psychology is shifting. Does that mean you should panic? No. Does it mean you should rush out and buy everything you can? Also no. What it means is that this is a moment to pay attention, to educate yourself, to think clearly, and to make decisions based on your own circumstances, not someone else's narrative. If you already own silver, stay the course. Hold with conviction, ignore the noise, and remember why you bought it in the first place. This is a marathon, not a sprint. If you're considering silver for the first time, take it slow. Learn the fundamentals, understand the risks, and start with an amount that won't keep you up at night. Build a position over time, methodically, without emotion. And if you've decided silver is not for you, that's fine too. Not every investment is right for every person. But don't dismiss it out of ignorance or fear. Understand what it is, what it does, and why millions of investors around the world choose to hold it. The crisis we're facing is not a silver crisis. It's a monetary crisis. It's a confidence crisis. And it's been building for decades. Silver is simply one of the assets that reflects that crisis most clearly. You cannot control the global financial system. You cannot control central banks or government policy. But you can control how you prepare. You can control what you own. And you can control how you respond when volatility arrives. That's the power of discipline. That's the value of education. And that's the reason thoughtful investors sleep well at night, even when markets are chaotic. The abnormal market move in silver is not a warning to panic. It's a signal to pay attention. And for those who understand what's happening beneath the surface, it's an opportunity to position themselves wisely for the years ahead. Stay informed, stay disciplined. And remember that, in the long run, preparation beats prediction every single time. Thank you for watching.